Hello, everyone. We are on episode number 9 today of Ask the Loan Officer. Today, we are bringing in David Toaff again with First Home Mortgage. We had a little bit of scheduling conflict today, so I called David about 30 minutes ago and said, hey, can you jump on the episode of Ask the Loan Officer in 30 minutes? And he said, sure, I can do that. What are we going to talk about? I said, I don't know. What do you want to talk about? He said, okay, let me do my hair and my nails. So we're going to bring him on in just a minute. But today we're going to highlight a little bit about who you work with matters, especially in today's super competitive market. There's multiple offer situations coming about after the first weekend of showings. So who you are linked up with and the relationships they have with other real estate agents definitely matters and puts you ahead of the game. We had a client last week, or maybe the week before, lose out on a multiple offer situation over in Harrison Square, which is an area of U Street corridor. So the property came on at 939 and my clients bid all the way up to 985 and we lost. So I did not suggest that they go any higher. I think that was capped out. So I hit the pavement and started door knocking and making some phone calls, trying to find a like property for them. And I got a response from a seller that wasn't planning on selling, but he's like, sure, I'll sell. Got that property, exact same property, not as renovated, but got it for $920. The appraisal came in yesterday at $959. So they are already in with a $39,000 increase in value from what they bought it on. We have David Toaff now. Hold on, let me get him on the screen. There you are. Hello, David.
Hi. Thanks for having me last minute.
Thanks for the last minute.
Sure thing. I'm excited to talk about this because it's just so relevant at this point. We're nonstop running into these multiple offer situations and trying to find days. So I think it's a very relevant topic, especially about to hit the spring market.
Absolutely. Absolutely. I put a bid on a property last week. And the client wanted to use his bank that he had from out west, and the listing agent said, "Have you worked with this bank before? I've never even heard of the bank." And I said, "Honestly, I really haven't." And she said, "Well, what do you think?" And I was like, "My client wants to use the bank that they've used in the past." And she said, "Can you run it by David Toaff?" And I was like, sure, I'll run it by him. But whatever the client wants to do in the end. So yeah, relationships definitely matter. And local banks, I'm seeing that agents are preferring because, they know these people.
Yeah, I just had a situation very similar where the agent on the listing side, multiple, every possible contingency. And she basically mentioned 3 lenders that she consistently trusts enough to where she doesn't have to ask too many questions. So it seems like we're in a very hyper-local market and it's just mattering more and more. And one of the other things I wanted to talk about is just how we've been getting certain clients ready when we know they're looking in like red hot areas and really hot price points.
Yep. Definitely, especially if you're in Logan Circle or Columbia Heights or DuPont. Some of these areas are that's where people want to move because that's the neighborhood that they know when they come to town. Now, sometimes I have to say, well, have you tried this other neighborhood that's just outside the boundaries? And they're like, well, my friend said that we're supposed to move here. And I'm having to introduce new neighborhoods to new buyers, especially people coming in from out of town.
Sure, and I guess you're probably seeing what I'm seeing, that all of a sudden some of those other neighbors are starting to get red hot also. It's Brooklyn and different areas are now becoming a huge challenge with 7, 8.
Brooklyn is, I can't believe it. Brooklyn has come a long way over the last 10 years. If you owned in Brooklyn 10 years ago, you're sitting on a gold mine. Same thing with Bloomingdale, right? I mean,
No kidding.
Bloomingdale's same thing.
Absolutely. And one of the things we have been doing, Mark, is just getting people's files completely underwritten ahead of time. So you basically can get to a point where the only things you're missing are a property, of course, a ratified contract. And with that, your appraisal, your homeowner's insurance policy, and the title insurance, title insurance and title policy back from the title company. But those things are fairly quick. And in that way, you can really get a loan commitment immediately, subject to those few items. And I think a lot of listing agents are really loving to see that when there's so many offers, and it seems like it can really make or break a deal. So,
absolutely. You mentioned title insurance. I know you're not a title attorney, but at settlement, we'll see a line item that says lender's title insurance, and then there'll be owner's title insurance. So the buyer pays for 2 title insurance policies. Why is that?
Yeah, so they do need to have the title insurance for the lender. So in other words, if there is an issue that comes up, for better or for worse, the buyer, even if I'm the buyer, is paying for the lender's title insurance policy, protecting the lender if, there's an issue in chain of title or a lien or whatnot on the property. And then the owner's title insurance, although it's optional, it's very strongly recommended by everyone I've ever spoken to. So yeah, I would say 99% of buyers are getting that as well. And that's to protect, their own interest in the property.
Yeah, I've never had if you're getting a loan, you can't opt out of the lender's title insurance because it is protecting you. But I've never had a buyer actually say that they did not want title insurance. Nor would I ever recommend that. When you're
one who decided to roll the dice and not have it.
Oh, wow.
Despite everyone's strong advice to the contrary.
Well, hopefully old woman Hilda doesn't come rolling into town and say, I never sold that property 30 years ago. That's my land.
Right. We'll see.
What I like about you, David, is that no matter where you are, I can pick up the phone and call you and you'll answer the phone. If I'm too busy, then I'll text you, and you could be in Miami and you text me right back. I think that this is a really important test for buyers nowadays in choosing their team, whether it be the lender or the realtor, is give them a little test. Are they answering your phone calls? Are they responsive to your emails right away? Or are they getting back to you in 24 hours? In this market, there's really no time to wait.
Yeah, you know what, Mark? I tried to buy a commercial property, or was considering it a few years ago, and trying to get in touch with the lenders was so incredibly challenging and frustrating. I just decided to not even bother buying. So it reiterated to me how incredibly important it is for me to be responsive. And, a lot of people, when the most expensive purchase they ever made might have been a car or a bed, and all of a sudden they're dropping $500,000, I have to accept and understand the fact that they're going to be nervous sometimes, even if everything is going extremely smoothly. And, I'm really learning how small of a town DC is at this point, because the majority of the offers that, my clients are writing on properties, the listing agent pretty much knows who I am at this point most of the time. Here and there, they don't, but at that point, they've pretty much heard of First Home Mortgage. So, that's been extremely helpful. One other thing we're doing, and, I know we're not the only gig in town doing this, is just rushing these appraisals. So, my company is pretty affordable. We only charge $75, have an appraisal rushed, and then, turning around in 4 or 5 days. Just, again, really easy way to get things knocked off the list and have everything taken care of. One more interesting little scenario I had come up recently. Actually, one of your colleagues at Compass, we bid on a property over in Silver Spring, and the comps were just not quite there yet to justify how, where the property went in value. Lo and behold, a comp sells a couple days after the appraisal comes in. We rushed another appraisal. We did a brand new one, got everything squared away, and closed on time. So, it's another example of if someone's not working with a local institution and needs to fix something that comes up, I can imagine how difficult that could be.
Yeah, when you are writing on a property, if this is your first time and you've never gone through the process, then there's some time frames that you are filling out. If the contract is contingent on appraisal, then there's a blank that we'll put, this is how many days it's contingent for, and that amount of time. I usually write down like 14 or 21 days to give the bank enough time. But that's one thing about you is we have been able to rush an appraisal, which gave me the ability to just turn around and write a smaller time frame in the contract. So if we were bidding against someone else and we had like offers, at least we had a financial contingency time frame and an appraisal contingency time frame that beat the other contract and took that contingency out of play. So I appreciate that part of your business.
Yeah, we're very glad to work with some really good folks. A lot of the people behind the scenes do not get enough credit, but my processor, who's also a qualified underwriter, which is kind of awesome, is 7 days a week. Also, she's working evenings. I'll check my phone at night, and she's submitting loans, to underwriting while I'm getting ready for bed sometimes. So I really have a rock star team. Her name's Alyssa. I gotta show her a little bit of credit here because I don't know what I'd do without her.
I love it. That's that's getting ahead of everything. If you have a processor that used to be an underwriter, then they can probably pick out any red flags before it even gets to underwriting.
Yeah, and she still will underwrite some files, but mostly on processing, and that's really where it's the most helpful because she's the one who's processing and underwriting our files in advance. So, for example, if a client's doing a jumbo loan, those take anyone a little bit longer than, just a regular conforming loan, like a loan under what's called the conforming jumbo loan limit. So basically in DC, anything above 679, 650, which is more and more of the loans that people are doing these days as the prices keep ticking up, you're entering this jumbo realm. So on those in particular, if we can get the whole file together and every little letter of explanation, sourcing deposits and get everything situated, I think our clients will have a much stronger chance of winning.
Yeah, just to clarify, the limit on a jumbo loan doesn't mean that's the price of the property. It means that's the amount of the loan, right?
Exactly. So anything above a loan of 679, 650, because that's the current limit in DC, Montgomery County, PG, Arlington, Alexandria, a lot of the areas around here. You start to get into the jumbo realm, and there's often a need for what's called reserves. So like if your file has 6 months reserves acquired, that would mean 6 times the mortgage payment extra showing in funds for closing. So those are the kind of things you really have to look out for when you get into that jumbo realm. There are alternatives to jumbos where we had a client, actually John, who did a first and second mortgage, if you recall. And in that case, you don't need to have these reserves. When you set it up as 2 loans, you can avoid, of course, doing a single jumbo loan. And the underwriting requirements are easier. So while there are alternatives, if someone wants to go with a standard jumbo, they really want to make sure to have all their ducks in a row ahead of time.
So you can do a product like an 80-15-5 or something to that nature. Is that what you're talking about? Like one loan would be 80%, the next loan would be 15%, and then the 5% could be your down payment or the like.
Exactly. So for our clients, for example, who are buying these properties that have great bones but need a lot of renovations, they're trying to keep plenty of cash in the bank. They can structure it as you were describing. And the other benefit there is that you're not going to have mortgage insurance. When they do get a bonus at work or they do come across some more money, they can, of course, pay off that second mortgage as quickly as they would like. there's no prepayment penalties, but it'll allow them to keep more cash on hand for renovations or whatnot.
Yeah, the second mortgage is usually the higher interest rate just because it's less that the bank's taking on, right?
Exactly. You have a smaller loan, and there's also a little bit more of an element of risk there. So in exchange for not having the PMI, the private mortgage insurance, that this cost that people typically have to pay when doing less than 20% down, they have this second mortgage with a little bit of a higher rate. Typically, we've seen for years a lot of people doing adjustable rates on their second mortgages. In this market, as you can imagine, when the government is talking about raising the prime rate, which is the short-term interest rate between banks, that is usually what the adjustable rate mortgages are based on for these second mortgages. So I'm really having my clients do fixed rate ones at this point. The rate might be slightly higher, but it's just a lot safer than trying to do a loan that can quickly adjust in this market.
Good point. Good point. If I want to buy a investment property, I already own a home and I want to buy something to rent out, what programs am I looking at for that? Do I have to come to the table with 20% down payment if I want to buy a rental?
If it's going to be a rental property, you are looking at least 15% down. I believe, first home mortgage and the majority of local lenders can do 15% down. You are stuck with mortgage insurance, though, when you do that. And in opposed to a person doing a primary residence where they're doing 15% down and the mortgage insurance is really pretty slim, you have pretty high mortgage insurance on your investment property. B, you can't actually cancel it until you refinance at a time when you have 20% equity. So if someone can come up with 20% down, it would be helpful. Of course, if the right property comes along and they only have 15%, it might be worth pulling the trigger, trying to secure the property, and then worrying about refinancing down the line.
That's a good point. Okay, so the mortgage insurance, do you have an example of what that cost would be? Like, you can pick whatever cost property. If it's like a $300,000 property, and let's say that I have mortgage insurance included in my payment, are we talking about like $300 more in payment? I know I'm putting you on the spot with this one.
No problem. Let me just run some real quick numbers for a $300,000 property.
Okay.
With 15% down, and get a feel for, assuming pretty good credit, what that payment would look like. So
yeah, let's assume that, the score's in the 800s.
Sure.
And I just decided that I'm going to buy this property. I have 15% would be 45,000, and I don't have any more. Do I hold off and wait till I get 20%? Or is the mortgage insurance added to my payment not really that much to worry about?
Got it. Let's take a quick look here.
Another thing that I've learned along the way is if you have a rental property right now and you want to buy another property, when they're approving you, they're looking at your homestead, and then they're going to look at your income on your rental property. But they're not going to give you all of your income, all of your profit from that rental property. They're going to give you about 75% of whatever that total is, because they're factoring in that the property is going to be vacant at some point during the year whenever you transfer one tenant to the next. So that's the way that they typically give you an approval on something like that.
Right. And I did get you those numbers. If they have great credit, it's not awful. On an investment property, you'd be looking at $74.38 a month.
Okay.
Not so bad. I mean, if it was a primary, you'd be looking at $38.25. So it's about double. If they have great credit, it's not so rough, though.
Interesting. All right. Well, I appreciate it. We are at 11:55, so we're right at our mark that we like to keep this. If you have any other questions for David, then his information is on this post, and you can also comment below, and he'll keep his eye on it. Appreciate you doing this last minute today, David.
Sorry about the lighting in here not being great and not having all this ready, but I hope some of this info was helpful. If anyone wants to discuss more about specifically the pre-underwriting, definitely glad to delve into that. But just to be clear, if all that is done ahead of time, you really could get your file closed, in other words, from ratified contract to finish in 13 or 14 days and really look a lot more like a cash offer, which is pretty phenomenal. No extra cost to the buyer to do that.
In this market, that's definitely a plus. Thanks for your time today, David. Happy Friday, everyone. This is the 9th episode of Ask the Loan Officer. I'm Mark Rutstein with the Evan and Mark team right here at Compass. DCRealestate.com has all of the past episodes. Happy Friday. Have a good one.
Thanks a lot, Mark. Take care.
See you.